Have you ever wondered what happens when a bank loan turns sour, when it becomes a non-performing asset or NPA? Don't fret, for today we will unravel this intriguing process using a case study to illustrate how NPA resolution works. Imagine a hypothetical situation where there's a manufacturing company named ProdTech. ProdTech borrows a substantial sum from a bank to expand its operations. However, due to unforeseen market fluctuations and management issues, ProdTech fails to repay the loan for over 90 days. The bank in this case is left with a non-performing asset. The bank's first course of action is to restructure the loan. It means altering the terms of the loan to make it easier for ProdTech to repay. It could involve reducing the interest rate, extending the loan tenure, or even turning part of the debt into equity. However, let's assume that ProdTech's financial woes are too deep and restructuring doesn't work. Now, the bank moves to the next step: recovery. The bank will try to recover as much of the loan as possible. It can sell off ProdTech's assets, which were pledged as collateral when the loan was taken. But what if the asset's value doesn't cover the outstanding loan? In such a scenario, the bank may use a method called one-time settlement, or OTS. In an OTS, the bank and ProdTech agree on a reduced sum that ProdTech can pay to settle the loan. It is often less than the outstanding amount, but it's a pragmatic approach given the circumstances. If none of these measures work, the bank has the last resort: legal recourse. The bank can take ProdTech to court under the Insolvency and Bankruptcy Code. Here, a resolution professional will be appointed to oversee the process. If the court finds ProdTech insolvent, its assets will be liquidated to repay the bank. So that's the journey of an NPA, from being a burden on the bank's books to its resolution. It's a process that requires patience, negotiation, and often tough decisions. To summarize, the resolution of non-performing assets involves several stages. It starts with restructuring the loan to make it easier for the borrower to repay. If that fails, the bank will try to recover the loan by selling off the borrower's assets. If the assets don't cover the loan, the bank may agree to a one-time settlement. Finally, if all else fails, the bank can take the borrower to court under the Insolvency and Bankruptcy Code. Remember, the goal of NPA resolution isn't just about recovering money. It's also about ensuring the borrower can continue their operations and contribute to the economy. It's a delicate balance between financial pragmatism and economic optimism.